Aerospace and defense ETF soaring? For a bold trade in this sector, trade DFEN, Direction's Daily Aerospace and Defense Bull 3X shares. Don't miss your next big trade. Direction Leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foresight Fund Services, LLC.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, coming up on today's program, part 2 of Portfolio Wars, a war of portfolios between Chris and Rocco. We're going to finish this off from last week's program and see who's got the better portfolio, who wins. Also coming up, have ETFs turned people into day traders? This is a topic we're going to discuss and dissect on today's program. If you'd like to join us to talk about any particular investments, stocks, mutual funds, ETFs, or investment strategies, 844-305-7800 is the number. Give us your first name along with your city, and we will get to you. Also, we're going to check out what's going on the Twitter feed. A lot of good stuff happening there. And at Index Show is the Twitter handle. If you'd like to send us a tweet, we can address your questions, your comments. And again, at Index Show is where you find me. Now, taking a look at financial markets, here we are in September already. Can you believe it? We've made it, and thus far it's been a great year for U.S. stocks. As a group, they're ahead by 10.25%. So we've now moved into double digits for U.S. stocks, and again, we saw the S&P 500 rising to a record high. I mean, it's been one record after the next. This time, we saw that there was a positive take on U.S. and Mexico agreeing to a trade deal, and now Canada in sight. Will Canada and the U.S. be able to come to terms? And, of course, the hope later on is that China and the United States will be able to come to some type of trade agreement and truce that will be amicable for both countries. So that's what's going on there. In terms of individual stocks making a move, we saw Amazon.com rising about 0.5%, topping $2,000 per share and heading closer to that $1 trillion valuation. So Amazon.com been a really good performer this year. On a year-to-date basis, Amazon.com is up 72% since the beginning of the year. That's a mighty, mighty move for a company with such a large market size. And, of course, that's one of the reasons the consumer discretionary sector, ticker symbol XLY, has been such a star performer, because Amazon.com is among the top holdings within that particular sector. Certainly has been driving that sector higher. Now, in terms of other areas within global markets, total bond market, ticker symbol BND, is down about 1%. Not much happening there. Of course, bond prices have been in a what you might say a holding pattern, especially since the trend has been higher interest rates, and so bond prices not moving much. In terms of commodities, as a group, they're down about 2%, and particularly metals have been weak as of late, precious metals. Gold and silver not performing well. VEA follows developed international stocks down about 2.3%, and then emerging markets down about 7.5%. And that shows you right there that the U.S. market continues to outperform its global peers rather easily and rather mightily. And one other area is global real estate, ticker symbol REET, which is now ahead by just over 3%. And man, what a move real estate has made this year. I mean, probably, I would say, of all the major asset classes, one of the most dramatic reversals we have seen in 2018. Global real estate in February was down around 9.5%, and now it's up just over 3%. So we've gone from negative 9.5% to now we're up to 3%. That's a pretty big move for real estate. And I know that real estate investors are celebrating, and that particular asset class has been really an amazing rebound and reversal. And then that particular sector, too, has also been a good performer inside the S&P 500 real estate companies, REITs, ahead by almost 5% this year. XLRE is the ticker symbol on that. So that's your big picture view of what's going on in markets. We give you this so that you can look, see, and compare the performance of your own portfolio versus some of these major benchmarks. And if you're underperforming, then that's a sign that there are some problems in your investment portfolio. Maybe you've got the wrong asset allocation. Maybe you've got the wrong building blocks. Maybe you've built your portfolio on a weak foundation. And so this is one of the things that we teach you on the program, is that there's really three components of a well-built, architecturally sound investment portfolio. And those three parts are a core or foundation, non-core, and then a margin of safety. So those three components, those three parts work together. Each one of those three, I don't really want to even call them buckets. You can call them buckets because they're not really buckets, but they're three pieces of the puzzle that play together and work together and complement each other and don't overlap each other. So that each one of those components does something radically different than the other. Your margin of safety is different than your non-core portfolio. Your non-core portfolio is different than your core. The core is different than the margin of safety. They're all different. And that's the whole point, is you want them to be different because of the fact that each one of them plays an important role in helping you to reach your financial goals, and also to have an investment portfolio, an investment mix that will always deliver satisfactory results, not just in a bull market or good market, but also in a market that's neutral, or perhaps even a market that is falling in value. So this is what we try to teach you on the program. And of course, where does the indexing come in? Well, that's your core portfolio. Your core portfolio should be 100% indexed to the market. And of course, you should have exposure to those 5 major asset classes in your core portfolio. You remember what those 5 major asset classes are? Stocks, bonds, real estate, commodities, and cash. Those are the big 5. 844-305-7800 is the number. This is the Index Investing Show. Coming up a little bit later, we're going to do Portfolio Wars Part 2, a battle of the investments and investors between Chris and Rocco. We started Part 1 of this on last week's program, and so we're going to finish this portfolio war and see who wins. Is it Rocco or is it Chris? I said Rocco, not Rocky. I know he wants me to call him Rocky, but he's Rocco. So that's coming up. Also, do ETFs convert people, have they turned people into day traders? And this is something that has been an argument that's been leveled against ETFs, especially, of course, anti-ETF types, detractors of ETFs, people like John Bogle and other haters that argue ETFs are one-dimensional trading tools that seduce people into hyperactive trading. Well, is that really true? Have ETFs turned people into day traders? What are the facts showing? What do they say about how individual investors, how financial advisors are using exchange-traded funds? So I'm going to bring you up to speed on that and much more. If you'd like to join us, we're here, 844-305-7800. Give us your first name along with your city. We'll get to you. If there's any ticker symbols that you want me to talk about or cover, give them to me. More when we return.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
Okay, one other company that I wanted to mention that closed at all-time highs, Microsoft. The company closed at a record of just over $112 per share. That is an all-time high. It got some boosting from the fact that consumers can now buy its Xbox One S for $21.99 a month for 24 months, including access to play games online with others in a library of more than 100 titles. And that was interpreted as a positive thing for Microsoft as it battles these apps like Fortnite and others that have become quite popular. But anyway, that's been a great performer. Microsoft, of course, a part of the technology sector within the S&P 500. Ticker symbol XLK is the ETF that follows that particular group, which Microsoft is a part of. XLK is ahead by just over 19%. And among the top performing industry sectors within the S&P 500. If you've been using leverage in this particular area, it's been a great trade. TECL, which aims for triple daily performance to tech stocks, TECL ahead by almost 51%. And that is the time and place to be using leverage. If you're going to use it, you want to do it in a sector or area of the market that is sharply trending in the same direction that you're trading. In this case, the direction is bullish, and it's been sharply bullish. And that's the time and place for leveraged ETFs like TECL, and that's why you're seeing it do so great. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here. If you'd like to join us, @Index Show is my Twitter handle. Get you caught up on some things that are on the Twitter feed coming up a little bit later. By the way, context for leveraged ETFs, where do they go? Which part of the three components of the portfolio do they go into? Well, that's the non-core portion of your investment portfolio. Remember, the non-core can always invest in areas that are more concentrated, areas that are maybe higher risk, and areas where that they're not broadly diversified areas. They're maybe focused on one industry sector or one particular sub-asset class. And so that's the context for investments like leveraged ETFs. Now, getting back to this portfolio war between Rocco and Chris, and as I told you on last week's program, if you missed it, just to give you a quick recap of what's going on here. Chris is single. He self-manages his investment account. He's 52 years old. He's got 20 holdings inside his portfolio. His current value is around $757,000. And Rocco's 55. He's got 11 holdings. He's got a mix of ETFs and stocks and one mutual fund. Chris has also stocks, mutual fund, closed-end funds, no ETFs from what I see in Chris's portfolio. But Rocco's got a portfolio valued at about $671,000. And so on last week's program, we looked at two areas. We looked at cost and diversification and who won the battle, who won the war in those particular categories, who had the lower cost investment portfolio. Well, Rocco won that particular battle because the expenses on his portfolio average around 10 basis points or 0.10%. He also doesn't trade very much. He does about 3 to 4 trades per year. And Chris's portfolio, by contrast, according to my calculations, has expense ratios over 1%, just over that amount, and is a little bit more active in terms of trading inside his portfolio, which boosts costs. So Rocco wins in terms of having the lower cost portfolio. In terms of diversification, Rocco won that particular battle because he's got exposure to major asset classes using diversified, broad-based index funds or ETFs as his core holding. He's got, we told you, exposure to U.S. stocks via ticker symbol SCHB. He's got exposure to emerging markets, SCHE. He's got exposure to REITs, SCHH. He's doing that in a very broad, diversified building block type of way, and that's good. He also did, by the way, have a little bit of exposure, or misses exposure, rather, to commodities. So that was something that was missing from his portfolio. Nevertheless, Rocco won in terms of diversification. I did not see any evidence in Chris's portfolio of broad-based index type of ETFs that are proxies for the asset classes where he's investing in. So although he does have exposure to stocks, he does have exposure to REITs, he's doing it in a very narrow way. He's got individual stocks serving as those holdings and individual REITs and closed-end funds that invest in these areas that do it very narrowly, and he misses the big picture, the big building blocks that are broadly diversified that serve as a core holding inside of his portfolio. So that's definitely a shortcoming, and it's one of the reasons why Chris came up short in terms of diversification. So Rocco won that particular battle. Now, in terms of the next grading category, we're going to take a look at risk. And when we talk about risk in terms of an investment portfolio, there's a couple of things that I look for. Number one, does the investment portfolio accurately, is it compatible with the investor? So is there a compatibility with the investor's age, with their level of risk tolerance? And if there's not, then that's clearly a problem. Now, the other thing I look for is, does the investment portfolio have an adequate margin of safety? Is there a cushion inside that portfolio? If market conditions change on the dime and suddenly start crashing and falling, then I want to see a portfolio with an adequate margin of safety that can be sheltered from the storm. Now, risk for Rocco, he told me his risk tolerance on a scale of 0 to 10, with 0 being the most conservative and being the riskiest, is a 5. He's right in the middle. And his portfolio currently has mostly exposure to equities. I also mentioned bonds. He's got a little bit of exposure to REITs. But I looked at his margin of safety, and he's just got 4% exposure to cash. That's Rocco. Now, the question is, how does that compare to Chris's portfolio? So Chris has got the bulk of his money invested in dividend-paying type of investments, closed-end funds. We gave you some of those ticker symbols, a lot of Eaton Vance closed-end funds, ETO, ETV, ETY, EVT. These are just some of the ticker symbols. CII is another one, QQQX. So in Chris's portfolio, his margin of safety, or area that he's allocated towards his cushion, is 15%, which is substantially higher. He's got a much bigger cushion in case things begin to turn. And for that reason, I think he does a better job at managing risk than Rocco. Rocco's almost fully invested. And you know what we say about fully invested portfolios? I don't believe in being ever fully invested. I think that's a foolish thing to do, because of the fact that all portfolios, young and old, new and experienced, should have an absolute margin of safety, a portion of the portfolio carved out for capital protection, zero volatility, and liquidity. And so Chris wins the battle on risk. Next up, we're going to look at taxes, performance, and then give the final report card grade and the winner of Portfolio Wars coming up. 844-305-7800 is the number. This is the Index Investing Show. I'm Ron DeLegge. Stay with us.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Directions Daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, let's check out the Twitter feed before we finish Portfolio Wars Part 2 between Chris and Rocco. Here's a tweet from a guy by the name of Shane Parrish. He says this: you could be wrong. Some guy, Jack, replied, well, you could be right. My response is, it's a coin flip, is what both of you should have said, with a emoji of a dice. And some fellow, SB Sway, jumped in and said, well, listen, if you spent your time doing the due diligence, cultivating an edge and levering up, it should never be a 50-50 split. People who seek alpha won't accept a binary event. My comment on that is due diligence, with a question mark. Every active stock picker on Wall Street claims they do it, and yet they still consistently underperform. Get serious. And SB replies to me, come off it. I reject your incredulity and limited perspective. Due diligence, edge, and asymmetrical returns are concepts that apply to much more than just securities and portfolios, which you style yourself as an expert in. My response to that is you're confusing me for dogmatic indexers that say 100% of your portfolio should be indexed. Your core portfolio should be indexed. However, if you want to gamble for alfalfa, do it exclusively in your non-core portfolio. That way, if your due diligence fails, at least your core portfolio delivered satisfactory results. So that's the end of that particular thread. Also, another thread talking about algorithms. Jim O'Shaughnessy says algorithms, and this is a quote from Dan Egan, quote, algorithms are much more, or are more often better at many decision tasks than humans. Yet research shows that we're more likely to choose a human forecaster than an algorithm. End of quote. Here's my response to that. Algorithms provide scalability and uniformity, but history is not on their side, and the next bear market will annihilate their enthusiasts. Beware of geeks bearing formulas. And Dave Pinson, he had this to say, well, not necessarily. If the algorithm includes hedging, my response to that is 100% of algo-built robo-portfolios do not incorporate a margin of safety where a percentage of the assets are strictly reserved for capital protection. So that's because the fact that they are strictly unhedged buy and hold strategies. That's robo portfolios. And in that context, algorithm is one-dimensional because it will only do well in a bull market. In a bear market is when they get annihilated. We haven't had a bear market since, 2008/9? And it's coming. We will eventually have a downturn in the future. It's guaranteed to happen. We just don't know when it will happen, but it will guarantee for sure. If there's one guarantee, they don't make guarantees in the financial services industry, right? Because they're not supposed to. It's against the law. But one thing I will guarantee you of is that we will have a downturn. It will be severe. And that's because it's happened in the past and it will happen again in the future. That's history, folks. And those of us that think that markets can continue uninterrupted without any pain are deluding ourselves. And this is especially why I preach very, very enthusiastically about the need for having an adequate margin of safety inside your portfolio. Robo-advisors don't do that. They don't have, they have cute algorithms, but none of them, 100% of them, do not have any portion of the portfolio reserved for capital protection. There's no active strategy involved in protecting people's money. It's all unhedged, buy and hold strategies, and then they bring on these intellectual types, these behavioral, what do they call it, economic, these folks that have studied behavioral economics and that have written books. And basically they're just telling people, you need to control your emotions. You need to be more disciplined when the market goes down. You need to hang on and wait for it to rebound. See, that's all true, but it also doesn't negate the need for people to have a margin of safety in their portfolio. And so this is why we try to help educate you about that need, especially for those of us that are nearing or in retirement. This is a crucial aspect of your plan. You need to have a bigger margin of safety because guess what? You're starting to withdraw assets. You're starting to deplete those assets, right? You're deaccumulating your money. And on top of that, if the market gets hit 20, 30, 40% or more, and you're taking out 4, 5, 6% or more on an annual basis, you can really begin to deplete your assets very quickly. And this is why, in some cases, that may be so quick you may not even have enough time to recover if market prices don't cooperate. So again, this gets back to the philosophy that I teach on this program of having 3 key portions of your portfolio earmarked for very different things: the margin of safety, the non-core portfolio, and the core. 844-305-7800 is the number. This is the Index Investing Show. I'm your host, Ron DeLegge. Just wanted to tell you real quick, ETFguide.com, the September issue of Premium is out, and there's a lot of great things contained within that. We've got an update of the long-short ETF guide for Q3. We've also got how to remove the noise in Mr. Market. Nice analysis there on how to do that. Also, the income trade, the monthly income trade for September, and selling covered calls for the month on the hypothetical income mix portfolio. This particular month generated almost $600 of monthly income, and going all the way back to February of 2012, the income mix portfolio has generated just over $46,000 of total income, average out to about $614 per month. And so those of you that are looking to add more income to your arsenal, aside from dividends and bond interest payments, take a look at the income trade portfolio every month, selling covered calls on an all ETF portfolio. It works. 844-305-7800 is the number. Let's get back to our Portfolio Wars Part 2 between Chris and Rocco. So take a look at the next category, which is taxes. We've got Rocco's portfolio, $671,000. $60,000 is in his taxable account, with the rest in his tax-deferred 401k and IRA rollover. Rocco does okay on taxes. I think he would do better if he had some Roth IRAs. He does not have any 401k loans. He does not have any premature distributions. That's good from a tax efficiency perspective. But all of his money is in the tax-deferred bucket. Why doesn't he have any money in the tax advantage bucket, which is Roth IRA? So your homework assignment, Rocco, is talk to your employer and ask them if they offer Roth 401k. And if they do, then you can start contributing some money to that Roth 401k. And if they don't, well, then you should contribute up to the match and not a penny more. And anything over and above that, you can open up a self-funded Roth IRA so long as you and your, your income level is within that that where you can contribute to the Roth IRA. You got to have, I believe it's $199,000 if you're a married couple. Less than that in order to contribute in Roth IRA. So this is some of the things that Rocco can be doing to improve in that category. We'll tell you how Chris does in terms of tax efficiency when we come back. 844-305-7800. I'm Ron DeLegge at Index Shows, where you find me on Twitter, and I'll be right back.
Investing Show with Ron DeLegge.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
Okay, in terms of taxes, we just told you that Rocco did okay in terms of taxes. Like I said, he's got money in a 401k plan, an IRA rollover, no premature distributions, no 401k loans. I, of course, would like to see a Roth IRA or Roth 401k option. If he can do that and contribute to that, that would be great. By the way, the contribution limits, that's the wording I was looking for, in terms of income, because there are income limits for Roth IRA contributions. For 2018, it is for couples $189 to $199. So what ends up happening is if you make $189 from that amount to $199, then you begin to have phase outs. If you make $199 or more in AGI, that's adjusted gross income, then you are phased out of being able to contribute to Roth IRA. The only way that you can get into Roth IRA, you high income earners, is to convert your IRA assets to Roth. That's how you get into Roth. You pay the taxes now and you convert, and that's how you get into Roth. For singles, it's 120 to 135. If you make more than 135 as a single taxpayer, then you are phased out of being able to do Roth IRA. So even though you can't make contributions, for those of you that are high income earners to Roth IRA, you can still get into it by making conversions. And it may make sense to do that because taxes right now are as low as they'll ever be. And if you look at the history of taxes, federal taxes in this country, you will see that is exactly the fact. Now, getting back to Chris's portfolio, he's got 100% of his money invested in a taxable investment account. He has no tax-deferred money. He's got no IRA or 401k. He's got no Roth IRA whatsoever. And he told me that he deliberately did that just because he feels more comfortable with that approach and not being limited by or restricted by things like required minimum distributions or being able to pull out money before age 59 and a half. So that's nice. It's good to have that psychological comfort, Chris, but at the same time, that hurts your portfolio in terms of tax efficiency. Plus, he's got all of these dividend-type paying investments, which are in those closed-end funds. They tend to pay pretty juiced-up dividends, high-yield type of investments. And how is all that money being taxed? Well, it's being taxed as income to Chris. And so that hurts him from a tax efficiency perspective. And I think, again, doing things like Roth IRA and having some money positioned strategically in these types of tax deferred and tax advantage assets would definitely help Chris. So Rocco wins that particular battle in terms of taxes. In terms of performance and investment performance, the way that we measure it is we look at the portfolio and see how it's done versus the benchmarks. Has it performed in line with the benchmark? Has it outperformed or has it underperformed? And that gives us a sense of whether the investments have delivered. And so in terms of performance over the past year, Chris has gained 7.4%. That's about a $52,000 gain. And he went from $705,000 and change to over $757,000 in 12 months. Most of that money was, of course, from not capital gains, but from income that he generated on the portfolio. And then in terms of Rocco's portfolio, he gained slightly more. He gained 9.7%. He had a $59,000 gain. He went from 612 to 671. And so Rocco wins in terms of performance. And so portfolio wars between Chris and Rocco wins. Well, this particular battle, it's Rocco. Rocco is the declared winner. His portfolio gets a B. Chris gets a C. Rocco won in 4 out of 5 categories. He beat Chris in terms of cost. He has a better cost structure, lower cost structure in terms of his investments. He had better diversification. He had a better tax efficiency situation in his portfolio, and he had slightly better performance. However, Chris did do better in terms of risk. Chris's portfolio has a much bigger margin of safety, and I like that. I like the fact that he's got a bigger cushion. Rocco can certainly look at that, and he's got a much smaller margin of safety, and certainly I think that could come back to haunt Rocco if market conditions change for the worse. So that ends Portfolio Wars. Great job to Rocco. Chris came very close to matching Rocco, but at any rate, it's been a beneficial exercise for both of them, and Portfolio Wars Part 2 has ended. If you'd like to get a portfolio report card where I analyze and grade your investments and perhaps even pin your portfolio against another investor, go to portfolioreportcard.com and get in touch with me. Now, getting back to the Twitter feed, because there's a couple things that I need to share with you before we take off for today's program, is a link of a screenshot from the just updated and revised edition of The Power of Zero by David McKnight. And it shows that the percentage of every tax dollar spent on Social Security, Medicare, Medicaid, and interest on the national debt as of 2016 was 82%. That's going to jump to 92% in the year 2020. So we're spending more and more money as a country on things like Social Security, Medicare, Medicaid, and interest on the national debt. And my point is this, folks, from a financial planning perspective, we're not looking at this from a political perspective. We're looking at this from a financial planning perspective. And the message is loud and clear. Those who say tax rates won't double need to brush up on history, because this particular chart shows you why they will double in the future, and that it's now is the time to shelter your money. I think David McKnight and his latest book, Power of Zero, makes a great argument for that. By the way, I'm going to have him as a guest soon on the program to discuss that and much more. Also on my Twitter feed, @IndexShow, taking aspirin, low doses of aspirin, according to a new study, is too risky for most people. My take on that, taking aspirin won't help your longevity. Eat less donuts and start exercising, folks. Here's another retweet. This is from David Schwallow. I think that's how you say his name. He says, even if you think you're intellectually right, if you've lost 25% year to date, you're not right. You're stubborn. I say to that, especially and particularly when it happens in a raging bull market. Here's another point to our first point about rising taxes. Seven Henrich says this: due to tax cuts, the federal government now collects less in taxes from corporations than in 1995, when corporate profits were 1/3 of what they are now. 2018 has seen a complete collapse in taxes collected. This will result in substantially higher taxes in the future. That's number one. And number two, your financial plan better not say that you're going to be in a lower tax bracket in retirement, because if that's what it says, it's wrong. Also, the SEC has charged Moody's with internal control failures and rating symbols deficiency. So that saga continues with the rating agencies. They can't get their letters correct and the credit ratings correct. And so anyway, you can read that and much more on our Twitter feed at Index Show. You can follow me there, tweet the program, and participate in the conversation. Also, by way of reminder, if you ever miss our regular radio broadcast, you can pick up our show. It's via podcast at indexshow.com. You can also find us on Apple, iTunes, as well as Google Play, SoundCloud, and also YouTube. Yeah, just search under the Index Investing Show, and you'll find us right there where we simulcast all of our shows. Well, that does it for another thrilling episode of the Index Investing Show. Be sure to join us again next week. Same time, same station. We're going to also talk about this topic of have ETFs turn people into day traders. That coming up on next week's show.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.